Okay, welcome everyone to another Local Administrative Advisor webinar. We're really excited. This is the fourth one that we've had so far, and we've got a couple more coming in March as well, so be on the lookout for those. My name is Liam Threlkill. I'm a policy analyst and program manager at the Utah League of Cities and Towns, the program manager for the Local Administrative Advisor program. Really excited about this webinar, excited about where this program is going right now. For anybody that might not be aware of the program serves communities throughout the state with a population of 10,000 or less, with an emphasis on 5,000 or less, that either don't have professional administrative staff, such as city managers or city administrators, or have new city managers or city administrators, or inexperienced city managers. So we're grateful for this program in partnership with the state, with the legislature, and with the AOGs, where each of these local administrative advisors are housed to really help their communities and be specifically in their communities. Today we have Mark Christensen, who's with us, the Saratoga Springs City Manager. He has many years of experience despite looking so young. We're grateful for him in helping us out today, and he's going to be going over dollars and cents in local government and kind of giving us an overview of these different revenue streams and where we can find more information about them. So with that, I will kick it over to Mark.
Great. Liam, thank you very much. And for any of the participants today, I'm happy to take questions and field questions throughout the presentation. If you have questions, happy to kind of address those as we're going on. Just a little bit more background about myself. I started off as an intern for Clearfield City, and then I became a legislative intern up at the legislature, pivoted there, went to be an employee up in Park City, then became the city manager in Saratoga, in Washington Terrace, and now I'm the city manager in Saratoga Springs. I've been in local government for over 25 years, and so I'm grateful for the opportunity to kind of share with you some of the thoughts and things that are pertinent to this topic of dollars and cents. Today, I would like to talk about a couple of different things as it relates to municipal opportunities for revenues and things of that nature. First, I want to talk a little bit about the tax theory. I just want to kind of hit a few basic points, and then we'll explore taxes, fees, utility services, business licenses, and other things. And then throughout here, we'll be talking a little bit about statutory authority and rules to implement and what fees are correct for the various communities that we work for. Ultimately, also going through a little bit on how fees are calculated and collected. So for a theory discussion, and for years, I was an adjunct professor up at the U, and so I love a little theory. We'll throw in here a little economic theory from Adam Smith, Wealth of Nations. The economic principle here is that that there is, and this follows pretty much the thought within the economic community, is that there's a general benefit to the public by having taxes in place so that you can fund things, as he says, that are reasonable and that ultimately are necessary for us to provide as governments. He does point out four general criteria that good taxes should follow, and that's one, they're proportionate to the incomes or people's ability to pay, they're certain rather than arbitrary, and then they're payable at times and in ways that's convenient to the taxpayer, and ultimately cheap to administer and easy to collect. And so, interestingly enough, I really like this because what we see up at the legislature is a continual battle to try and balance these things, whether fees are appropriate, whether fees are specific to what they're being charged for, and ultimately, how is it easy for people to predict and to be able to understand where their fees are coming from or where they're going to relative to the services they're receiving. So here's another few points that I wanted to bring up before we get into this, because a lot of the communities that you're going to be working with will be struggling with what kind of taxes should we be charging, what kind of fees should we be charging. The general concept here is that there's three basic types of taxes or fees. There's those that are regressive, and as you can see by the images, a regressive tax is something that's going to tax a low-income individual at a higher percentage of their income or their wealth than someone who is wealthy. And that's generally considered a regressive tax. For example, a gallon of milk or buying gas at the pump or something like that, even though it's the same tax on that particular commodity, it is impacting a lower income individual at a higher percentage of their income. A proportional tax is exactly that. It takes a percentage that's an equal percentage across people's income ranges, and it shares that proportionately. And then there's the progressive tax theory or fees that are really looking at taxes as a percentage of someone's income. And this is kind of an interesting concept because, for example, a regressive tax could be something that is a gallon of milk or something that is a basic life sustaining commodity. But a progressive tax, if that tax is tied to, say, the value of a car, it's going to progressively get more. So, for example, if someone's buying a very small economic car, their proper or their sales tax or their tax on that would be representative of the price of the vehicle. And the person that's buying a vehicle has a choice to choose between a very expensive car or a cheaper car, and they would be able to choose what level of tax they want to pay based on the cost of that vehicle. And so that's a progressive tax, and property taxes and other things can be progressive depending on how those things get. Restaurant taxes, hotel taxes, even if you're choosing to use those kinds of facilities, would be considered progressive in the sense that, if you have the ability to go to a more expensive hotel or something like that, you'd be paying proportionately more on that. Now let's take a jump. This was covered really well by Adam in one of the recent presentations done here in the LAA world. But in State v. Hutchinson in 1980, there was a court case that basically said, it changed us from Dillon's rule to more of a home rule state with some modifications. Well, Hutchinson really gives us power to do a lot of things. Municipalities under Hutchinson rule generally have the power to act in any area that it's not prohibited by state or federal law. And so in planning and in the services that we provide, we generally have broad discretion in the types of things that we do. Now, there's a challenge to that because for example, the current state code allows cities to financially operate based on whether or not, in the judgment of the council, it's providing for the health, safety, prosperity, moral well-being, peace, order, comfort, and other things of the community. And as long as it's generally accepted and generally approved in the community, it's a permitted use. The problem is the legislature has carved out and said the ability to charge fees and to charge taxes, we're very much going to limit that. And so although we have that overall health safety ability, we're very much limited in what we can do inside the world of raising taxes. Specifically, sections of codes limit our ability to impose taxes to those that are specifically approved by state statute. They can control our finances. They can control our requirements as it relates to appropriating funds, setting budgets, building infrastructure, how that money gets used to fund infrastructure without going into fund accounting. The types of revenues that we collect and the types of fees that we collect have very specific ties back to the services that are being provided. So as we can continue down through the various fees and things, and I'm really focusing on the fees that are really capitalized very well in powers and duties. But generally speaking, we have some parameters that we're going to need to follow. And so hopefully those make sense as we continue through this discussion. So the main taxes that we're going to really have an opportunity to hit on today is property taxes, sales and use taxes, and fees. Now, fees, I'm kind of breaking into a couple different categories because you have business license fees, development fees, and other things. You have impact fees that are eligible for us, but then utility fees kind of break down and they're treated they're a little bit different. There's commonalities and it's different. All right, so that was a mouthful. Let's take a second and let's look at the reality of what we're talking about. I've given a little theory. We've talked a little bit about what our abilities to charge these fees are. But I think it's really important that we understand that any taxes and fees, basically depending on which community you're serving in, will have a bit of a pitfall associated with it. For example, this cartoon by Grondel does a great job of emphasizing that sometimes taxes or fees are very politically unpopular in their community. But at the same time, we have communities that are trying to be fiscally sustainable. They're trying to provide efficient and effective services and programs. They're trying to give essentially what the residents are asking for. Residents want libraries. Residents want great recreation facilities and parks and programs and other things. But oftentimes it comes with a mandate from the people that says don't raise taxes or fees. And so we get stuck in this dichotomy of how do we pay for the things that we want and that are politically popular for us as communities to provide, compared to how do we actually service and raise the money to do that legally because our hands are somewhat tied. So let's jump into property taxes. Property taxes are just a very kind of a cool concept in the sense that we have an opportunity to collect taxes. There's three different types of property taxes that all fall within property taxes. There's real property. This is basically your real estate property. It's, it's generally speaking what you think of when you think of real estate. Personal property are like cars, boats, furniture. In the business world and in the commercial world, it's the value of materials, or it's the dyes, it's the tools. It's like ski lifts or something like that. If you have ski lifts and other things that are used to create the economic value for that particular business or whatever's operating in your community. And then you have centrally assessed properties, which include mines, airlines, utilities, any of those utilities that are cutting through your communities. You're getting the state will calculate and remit taxes back to us in the form of property taxes based on the asset value of what's going through the various communities within which we work. So those are the three basic categories of that. Now, when we go to set property taxes are considered to be revenue neutral, meaning that as a city council or as an elected body, they hold the ability to charge a tax rate. And so the citation here is for the Fiscal Procedures Act. And basically the council or the elected body has the ability to set a tax rate. Now, if the tax rate is equal to the amount of money that was collected the previous year, then you're not raising taxes, you're just maintaining that tax rate. That's a no tax increase. No tax rate increase, or a revenue neutral option. If you want to raise taxes, you're going to have to go through a truth and taxation process. I'm not going to discuss that here because it's a complex process. There's lots of nuances, and we've got another speaker that's going to really focus in on that. But you can, in a community, also decrease taxes. So really, there's kind of three options for each elected body in the annual budget process. We have to either accept a no tax rate increase option, which means that it's revenue neutral. Revenue neutral doesn't mean that the value of taxes don't change or your assessed value doesn't change, and I'll explain that here in a little bit. But it just means that you're setting your rate so that you collect the same amount of money that was budgeted in the previous year or in that year, so long as it's not changing. Tax decrease. Oftentimes councils want to, understand and address and reach the needs of their community. There will be times when communities will do tax decreases. That doesn't require any special public hearings or anything like that. You just adopt a tax rate that decreases the budget, and then that goes through. And then, as I mentioned, the truth and taxation process, if you're going to raise taxes. There is an exception, and that is if the property tax is less than $20,000 per year, you wouldn't necessarily have to go through that truth and taxation process, but we'll leave that for another time. Property tax. Here's the process whereby we go to implement a property tax or to change that property tax. It says the municipality shall, by ordinance or resolution, set the real and personal property tax for that town, for that town's purpose. It may not exceed a 0.007 per dollar of taxable value on the property. And then ultimately, once that tax rate has been set, it then gets distributed, sent to the county auditor. They certify rates, things of that nature, and it gets the ball moving. One thing to note on property taxes are assessed by the county assessors generally. It's assessed as of January 1st. So whatever the condition of that property is on January 1st is the value that is attributed for that particular tax year. So for example, we're fresh into 2024 at this point. So as of January 1, what was the taxable value? So in a high growth city like we're currently in Saratoga, we have a lot of building permits that get pulled. The assessed value is what was the condition of that property as of January 1st. If a building permit gets pulled mid-January, that property for that year is being taxed as if it is just an empty lot for that year. Interestingly enough, if they pulled, so in a community that's a high growth community, we wouldn't see the property tax on that particular parcel until the following fiscal year, and we'd get that in about November or December of that next fiscal year. So a home that started, say, mid-January this year, we won't receive any property tax value for the value of the home until November of 25. And so there's these nuances and these subtle nuances that we all have to be considering as we look at development and growth in our communities. We're going to dig into this a little bit more, and I apologize. This next sheet, it's a little bit busy, but let me kind of walk you through this. This is from the Utah.gov tax website. You can pull this data and go onto this website and pull data from any taxing entity in the state of Utah. I log in as the guest using their guest portal. I chose Willard for today. Willard's a great little town. I'm familiar with it. I love it. I wanted to use this as an example for us, and then I'll share and contrast what's going on in Willard with a little bit of what's going on in Saratoga Springs. But I wanted to give an example of kind of two different elements of communities. So in this particular case, right up on the top, we can see that the final tax rate that is being proposed for tax year 23 was a rate of 0.00917, and that would bring in a budget revenue of approximately $265,000. Now, how you come to this value? I mentioned before the three types of taxable property. You have real property, you have centrally assessed property, and then you have personal property. And so if you're looking at this, you can see the real property value here. You can see the 2022 year end, and you can see the 23 original property value, and you can see that there's a delta of about $46,000. Now, that's a 21% change. And if you recall, between 22 and 23, we were seeing a lot of assessed values that were increasing during that time period. And so a lot of swing on assessed value. They did experience some new growth. So if you look towards the center of the slide, you'll see this real property new growth number. You can see that in Willard City, they had $6.7 million worth of real new growth, which is an awesome thing for them. You can see that the value change was positive for $39 million as well. So in the end, it nets about that $46 million change total for the tax year. Now, if we go over to the new growth totals in that third column on that top box, you can see that there is a couple things. You've got the new growth that's transferring up. That's the $6.7 million. You can see I've put a mark here in the chart showing that the tax rate factor is factored into the adjustment. In this particular year, you'll notice that blue box is 94.41%. It's a really good tax collection rate. The problem is as we start to see recessions and other types of fiscal constraints in the market, you'll start to see tax rates decreasing. So if you go down to that third column and that second box down, you can see third row in, you can see the average 5-year collection between 22 and 23 has actually decreased. So in 22, in Willard City, the tax was being collected at about a 95% collection rate. Well, it dropped about 0.5% in that 1 year from a collection standpoint. So the tax rate is basically, and if you look at kind of the three arrows in that second box on that third column, you see the total adjusted value. In this particular case, it's that purple box of $306 million. The Board of Equalization, that is people that are challenging their tax increases for that particular year. And so the Board of Equalization has done some adjustments on those. That gets factored into the tax rate being set. And then you've got your collection percentage, and they're going to set your rate looking at that 5-year collection percentage so that it generates roughly the same amount of money each year. That's the revenue neutral of what's trying to be adjusted. And so as you look at this, you can notice that the state tax commission, the county assessors, and there's a lot of work that's going in to try and figure out what is the value of these properties. And because property taxes are revenue neutral in this case, the rate are going to go up and down based on the assessed value of what's in the community at the time of the start of the year. So in this particular case, you'll notice that big circle right there on the bottom. The certified tax rate with new growth is going to equate, and this is that bottom bar there. You'll notice that over, you've got those big ovals there. You'll notice that this particular tax rate with the new growth revenue being added into it at the final rate it will generate roughly the same amount of money that was budgeted in the previous year, plus the value of new growth. And so this is kind of the math of how this works. $6.7 million, great new growth for a community of this size. You're noticing assessed values have gone up in the past couple of years. We're probably going to see in 24 some pretty stark declines in assessed value, because the housing market's probably going to be seeing more of a de-escalation or a deflation of value, if you would, relative to that. So a lot of pieces that I just showed you here on Willard. I'm now going to jump over to Saratoga Springs and realize that one is a much smaller community than the other, but there's some interesting things on Saratoga that I want to point out for you. So first thing, you'll notice our tax rate, which is a little bit higher than Willard City's tax rate. The budgeted revenues is going to, theoretically bring in a little over $5 million in budgeted revenues, which is fantastic. As you look between 22 and 23, you'll see that values have changed, and this is showing a negative value happening here, because when you factor in the new growth that happened here in the city, you can actually see that our positions have changed a little bit relative to that. So in this particular case, you can see that if we're looking at that real property value, you're seeing that the value change decreased with a devaluation of the real property. But we built a lot of homes last year and a lot of businesses. And so the assessor is giving us credit for, nearly $500 million in new real estate value that's come into the community, $518 million. But that's being offset by values of the previous housing stock declining. And so you've got an interesting balance here of new growth that's happening, but you've got assessed values that are dropping, and those both get factored into this. So you'll notice in that second column, there's a declining AV value here of that $64 million, and that is the homes that were built prior to this particular tax year. They're then factoring in that new growth. If we go to the third column, you'll notice that our collection rate, the 5-year average of our collection rate, is actually less than Willard City. And then you'll see that it then equalizes and gives us a collection rate adjustment for new growth. And so these build into that final, or that second box on that third column there, where it gives you your certified tax rate calculations. Now, if you notice in that first line, it's R plus CA plus PP. That's basically real property plus centrally assessed property plus personal property to come up with that total taxable number. You can see our Board of Equalization adjustment was 7.4 million. And then you've got your collection rates between 22 and 23 that have actually changed slightly. But again, this is a full 1.5%, almost less than what you were seeing in Willard. And then you've got your proposed tax rates, and then your certified tax rate. And then there on that bottom row, here's the interesting thing that happened. If you compare that first arrow on the bottom row, 2022, we had a 0.001028 tax rate. You'll notice that the tax rate is actually going up in the yellow second arrow on that bottom row. It's going up essentially from a 10028 to a 10043, and that is to account for that decrease in the assessed value adjustment that's taking place. That's a big mouthful. As you look at each of your communities where you serve or where you're helping them, it's important to understand how these pieces come together. There are some other nuances which we won't really get into today, but you have a lot of second homes, like in resort communities. Second homes are assessed at 100% of their assessed value, where typically your residence that is being used primarily as a first home here in the state of Utah, they receive a 45% exemption on their taxes. And so if you're looking at resort communities or small communities that qualify for those resort taxes, you'll have those nuances that also get played into it. So a lot of stuff going on, but this is essentially how these rate details work together to help us calculate and then project our revenues for this year. So in Saratoga's case, our certified tax rate from last year would have been 4.5 million. We can adopt a budget at 5,035,646 this year. We can adopt that property tax, and we will be doing it at a no rate tax increase. So we won't be doing a tax increase. We don't have to do a truth in taxation for this kind of an adjustment because the new growth as well as the assessed values are basically raising that budgeted amount. So that's a little bit of a nuanced thing, but I just wanted to point that out for people to consume that. Let's see. So this next slide, what I wanted to do was kind of give a picture of Saratoga Springs assessed value, or I should say assessed values, or taxable value, but also our property tax rate. So this goes back to when we incorporated as a city. The city incorporated and we had a tax rate of 0.002503. And then the city was in a fast growth, a lot of growth was happening. So these values are essentially jumping from, 190 million on up to $1 billion in 2008. And so you can see a lot of value that's really growing across the community. And as we're growing, because the assessed value was going up so much, our rates were continually coming down to generate the budgeted revenue, which included new growth being added to it. But ultimately, we got down to 2008. In 2007, we started to have a pretty severe recession. You had a lot of delinquencies. I think during that time, our delinquencies, it currently is showing somewhere around 93% delinquencies or collection rate. During that time, I believe our delinquencies got down into the mid 80s. And so we were looking at a pretty significant number of people that weren't paying their property taxes. And so all of a sudden, you've got values that have gone up, but now you've got rates that are going to have to adjust to offset the delinquencies. And then in this particular case, the council had to do a property tax increase to try and fund some of the shortfalls that were happening in the budget. So you can see that red line, that was part of a truth in taxation process that the city went through. And then our rate continued to adjust up for a couple of more fiscal years because of the assessed values continuing to decline. And you can see in kind of the background of the city taxable values, you can see how we dropped from $1 billion down to about $750 million, just about $750 million in the 2011 timeframe, and then it goes back up, and it's not until about 2014 that we get back up to about that $1 billion assessed value or taxable value number. And then, as you can see, it's continued to grow. Now, the council since 2008 hasn't raised property taxes from a truth in taxation standpoint, and you can see that trend, because of the growth that's been happening, the rate has been declining. And then we get out here to 22 to 23, and I wanted to highlight what we've just talked about. Again, because the assessed values have come down, even though we've grown with new growth, the assessed value has come down and the rate automatically adjusts up slightly to recoup the lost value of that assessed value calculation. So just for illustrative purposes, I wanted to kind of give you a kind of a big picture of how this works in kind of a practical application setting. Excuse me. And I didn't want to throw anyone else under the bus, so I figured I'd just use the city I work for as data for this discussion. So that's property taxes in a nutshell. Let's see here. In Utah County, the tax rate that we charge, ours is only a very small portion of it. In fact, Saratoga Springs for 2023 was only 16.16% of the total property tax bill for the residents here in Saratoga Springs. And you can see Alpine School District here is about 67% of the tax bill, with Central Utah and the state with small numbers, and then Utah County, just slightly below, about a third below where we are as Saratoga Springs. You'll find this probably be fairly consistent across the state, although the numbers will change based on the community and where you're at. You will see these kind of dynamics largely going to fund schools and largely being pulled into that school world. I love this. This was a cartoon I collected years ago. This was regarding the burn plant that was up in Davis County. This was basically the taxpayers up there asking the question, hey, wait a second, if we've paid this off, shouldn't we be getting a decrease in our property taxes? And I think that is the fundamental principle that our councils and our elected officials sometimes struggle with is that taxes go up, but taxes should also come down at some point. And so that's that political balance of when is it appropriate and when should a council consider what those ramifications look like. In this particular case, they're vilifying governments for not lowering taxes. Let's talk a little bit about sales and use tax. I love this. This is language that's enabling us to collect taxes. It says it is the purpose of this part to provide the counties, cities, and towns of the state with an added source of revenue and thereby assist them to meet their growing financial needs. It's the legislative intent that this added revenue be used to the greatest possible extent to finance their capital outlay requirements and to service their bonded indebtedness. I think that's great. I think we need to remind them often when they start talking about taking away sales tax that this is some of the purposes of that. Now, sales and use tax, there's kind of a lot of pieces to it. I'm going to kind of go through it pretty quickly, but typically we have to adopt it by ordinance pursuant to the different section of code. And what this is really pointing at is when we enact a sales tax in our community for the local option sales tax, it's generally going to be spent 50% based on population and 50% based on point of sale. And so again, here's the various sections of code as it relates to that. So the point of sale is any of those taxing units within your community. This changed a little bit. This is a chart that we've used here in Saratoga for a while to kind of track where our tax is coming from. We didn't have a lot of points of sale for tax transactions until you can see that began to grow in about 2008, 2009, and then we've been growing ever since. But prior to that, the majority of the tax that we were getting was because of the state contribution based on our population, as opposed to the point of sale. And so you can see there's typically winners and losers within the sales tax world. And oftentimes communities look at like a community that has a lot of retail in it and they say, oh, they're just getting too much money. But that's really a difficult philosophical point because that money is also being distributed based on population. And that's where that comes to fund smaller communities that don't have large point of sale distribution points. And so we've got to remember that it ebbs and flows. And in some cases, you're going to be winning on population. In other cases, you're going to be losing. I did want to point out, you'll notice a pretty stark change starting in about 2019 in the amount of point of sale tax that we started collecting. This is probably true for most of the communities that we work with. And this is because of the Wayfair decision and the basically the online sales tax simplification, where they unify, they basically consolidated the online taxes. They fixed a lot of the pieces that were broken. And then we as communities started to collect this point of sale distribution for the online sales tax distributors. And so that was a pretty big deal for all of us. And again, the scale of this chart will change in each community, but the principle should pretty much remain the same, is that we benefit at some points based on our population and our point of sale. And then at other times, communities get a little heavier on the point of sale, and they are the ones that are helping to, supplant the deficits in our communities relative to that. So this is just kind of a quick text version of what I'm about to show you. Generally speaking, the sales tax on food is 3%. That's gone back and forth, and that is for food ingredients. I want to be sure that we kind of focus on that. During my career, I've seen the state take sales tax off of food and put it back on. Cities, we realized that's a really bad policy, and so we fought really hard to not have sales tax on food be removed from our tax base, because it is a very stable portion of that tax base. And kind of the theoretical side of that is you need that to support life and sustain life. And that's both, progressive and regressive in some regards. But the important part of it being attributed to that is because it's very stable. And during recessions, that portion of the sales tax remains very stable. Whereas car sales, luxury items, other things, those are the things that people generally cut back during recessionary times. And so again, as you're looking at this menu of sales and use taxes that may be eligible for your community, you want to make sure that you try and find a good tax structure so that you're not too dependent on revenues that may not be bulletproof, in recessionary times and things of that nature. So we'll move on. This is a tax chart. You can get it from the state website. I wanted to point to a couple of things. First of all, you can download the whole spreadsheet for all of the cities and governmental entities in the state that collect taxes. I took essentially that spreadsheet and carved it down to where we could kind of have a conversation about different types of taxes and things that communities use. First thing I want to point out in that far left-hand column is you'll notice that this also includes MIDA city or MIDA entities that have the ability to collect and use sales tax. This is kind of a big deal. This wasn't the case until several years ago, where these MIDA entities did not have taxing authority. Essentially, when they were created, the government made them let them have powers that historically had only been reserved for your traditional government services. And so they're giving them the same status as municipalities. That's another probably another training broadcast. But if you'll notice, you've got the common rates. Typically, those common rates are fairly common. It's going to be your state sales tax. It's going to be your local sales tax. That 1% is the 50-50 distribution based on population and point of sale. You've got your county option sales tax where they're getting it. Then the next, I'll call it a column, but it's your transit and highway taxes. And there's all kinds of different transit and highway taxes that are in this category. You've got mass transit fixed guideway, you've got a highway tax, you've got airport taxes, you've got supplemental taxes, and you've got kind of a smattering of different types of taxes that counties and agencies have used to help fund their various projects and things in that realm. Then we get into the hospital tax, which is the RH code. You'll notice we got Beaver City and Dutch John. Sorry, is that Dutch John? No, that's Bountiful. Sorry. That have that tax that are showing here. Again, there's hundreds of agencies on this particular spreadsheet, and I just kind of shrunk it down to kind of shine a light on some of these. You'll notice that there's a county public tax that is being collected, and that's the CP tax there. We went to rural hospitals. You've got zoo arts or parks taxes depending on which county or where you're at. Sometimes it's called a RAP tax. Sometimes it's called a ZAP tax, depending on if you have a zoo that you're using to fund. But that's also available to us. You can adopt that, and then you have to re-up it every 10 years, but it has to be voted on by the citizens. You've got the city-town option taxes, where we've got a couple cities that are showing that town option and city or town option taxes. Again, you've got next to it the resort community tax. And a resort community tax is basically those communities that have a certain percentage of transient room nights in their communities. They're eligible for that tax. So especially small communities off the Wasatch Front, if you're in a community where there's a vast, I think it's like 65% of your properties that would be owned by secondary owners, that would trigger the ability to collect these taxes. That's something that's out there. And then you've got a correctional facility tax that's showing up here in this column as well. And then you've got your combined tax rate. Again, this is a menu of options, and it really comes down to what works well for the community and what you feel as a community is most appropriate. This is just some sales tax analysis that we have going on here in the city. We hire a consultant and they provide some data for us, but you can see, kind of the trends that are going on. If, all of us are collecting sales taxes, we're collecting municipal energy use sales and use taxes. We've got a lot of taxing pieces coming together. It's important that we're analyzing and tracking those taxes and making sure that we're receiving what we're looking for. Municipal energy sales and use. It's basically to provide a stable revenue source for cities to regulate, for us to collect money for businesses that are using our streets, highways, or other properties, and it's in those right of ways. And so again, the cap on this is usually 6%. There are some pieces to it. It's enacted through an ordinance. We have to notify the tax commission. And then something to point to, and this is really for those cities that are operating their own power utilities. They must levy the same tax on themselves as if they were a private entity. So it's not like you could, charge, one entity a tax and then not tax yourself. So we've got to have some parity in the market, is what this is saying. And then obviously, if we're enacting a tax, we have to do it on specific dates so the tax commission and those folks can build it into their models. Telecommunication tax, that's a tax that we can charge on, cable, cable, different kinds of franchises, things of that nature, up to 3.5%. And really the question that all of these different taxes beg is, what's the right tax structure for your community? Well, the answer is every community is different. Every community needs to balance what their citizens want, the services they want, the things that they need, and what is an appropriate level of taxation that the community can support. And so it's really up to the community to make that decision. And as a bunch of cities here in the state with the league, we try and support flexibility so that each community can have the option of choosing what's best for them. And it's not that one size fits all mantra of often what gets perceived in the state. So a couple quick things. St. George has a great budget policy. As I was preparing for this, a couple things jumped out. This is exactly what I was talking about. Each community has the right to communicate and collect those taxes and fees. And in their budget document, they have, if you would, almost a tax theory statement from the city establishing what its goals are. It wants to maintain a stable tax rate. It encourages diversity of revenues so that they can be bulletproof or sustainable, depending on recessions and other things. They want to look and determine the public benefit versus private benefit. They want to discuss if they're subsidizing private services. All of these are great concepts to consider. Generational fairness. Should existing taxpayers be subsidizing new growth? Those are the kinds of things that each of the communities will want to consider. I throw this up there as an example. They've picked the revenues that work well for them. Nibley City, great. I love this budget. You'll notice here, you've got your your budget document here, which is projecting out revenues for multiple years. It's projecting it way down into the future. I love the fact that they're looking out to see theoretically what their revenues would be looking like based on their growth patterns and other things. It very clearly articulates the taxes that are appropriate for their community. And so as we help communities identify and as we look to identify what taxes are appropriate for the community, each one of these are going to be very specific and different. I'm going to give you a couple more examples. For example, St. George, these are the kinds of revenues, and this is the distribution of revenues that they deem as appropriate to meet the goals that they had expressed and I showed on a previous slide. This is probably very appropriate for St. George. They have a lot of tourism. They have a lot of different impacts to their community because of that. And so they're structuring their taxes and their fees so that it matches the type of community that they are. That's super appropriate. Nibley was doing the same thing based on their community. Each community needs to have those same philosophical discussions. Comparing two large cities, sorry, these were documents that were easily available online. But again, I wanted to show the balance of even a Sandy City and a Saratoga Springs. You're going to see vast differences in how those taxes and all the revenues are kind of set up for that particular community. So again, it's a community decision and a council's decision on how you're trying to fund your community based on your community and the needs of your community. Here is the capital or the expenses, all funds, consolidated expenses for both those communities. So again, you can refer back to these slides and see how they're collecting their revenues versus how their expenses are being handled in their community. And these are consolidated as well. Fees. This is where we get into a little bit of a challenge. And so for the next, 10, 15 minutes, I want to kind of hit on this. There are some important elements that are going to go through all of these particular things. Generally speaking, fees have to be justified by studies or by analysis that helps to make sure that you're charging fees for a specific use, and that fee has to be generally related to that use. Whether it's a utility fee, whether it's a charge for service, whether it's a franchise fee, whatever, we need to have those things generally funding these things as appropriate. Now, a lot of this is in duties and powers, so I'm just going to kind of hit on it. We have the ability to grant franchises to public utilities, to use easements and other things. It's complicated. Setting up franchise fees is important. Getting it right is correct. And then you're going to have a percentage that you're going to have to follow within that. Agreements are complicated. So if you're looking for new franchise agreements, you're going to want to make sure that you're looking at that appropriately. There is differences between a cable company and your ability to charge for, say, internet. Internet, you can't charge a franchise fee for that. you can charge for like a cable company or something like that, providing cable services. So again, nuances that you're going to want to look into. Business license fees. Under Utah state law, this changed in about 97. I was an intern for Clearfield City at the time, and I got to work on their business license program at the time, but it says you can impose a business license to recover the municipal costs of regulation. That is very specific to how much does it actually cost you to administer it. So for example, if your clerk uses X amount of time for issuing a business license, there's X amount of time for a fire inspection or a planning review inspection. You can charge for those things, but it's very narrow and you have to be very limited on it. There are two exceptions to that rule, and that's whether or not a business is constituting a disproportionate cost to the community, or if there's an enhanced level of service that's being operated or provided to that particular business. A disproportionate cost could be the cost to regulate it. There's an example from many, many years ago in my professional life. We had a bunch of assisted care facilities in our community. Their policy internal to their operations was if someone has a slip and fall, you immediately call 911. So we had a lot of calls to these. In fact, the largest portion of our calls as a community was to respond to these slip and falls in the assisted living homes. And so we went back and we did a disproportionate cost analysis, and we felt like it was an appropriate thing to charge assisted living facilities a higher fee because of their disproportionate impact on our emergency medical services. That was an appropriate study. Other cities, such as Park City, they charge an enhanced level of service, and they use that to fund their fare-free bus system up in the Park City, Summit County area. So again, those are very appropriate things to do, but you have to do the math to justify that fee. One thing I would strongly recommend, please do a study to determine your fees. Do not just call another city and say they're charging it, so I'm charging it. That's the wrong way to do it. B&C road funds is something that we're all eligible for based on, the miles in our communities and our population. Again, there's all kinds of different transportation taxes that you can apply for. These are really more specific to the gas taxes that are charged at the pump, and then they're distributed based on the allocations. Municipalities, especially smaller municipalities, you have the ability to contract with counties, states, or other agencies so that they help maintain your roads, or you can do it yourself. And it really kind of depends on what works best for your community. The one thing I would say is if you are growing and if you're adding lane miles to your community, make sure you constantly are updating that formula with the state, because if you fail to report to the state the new lane miles that you've added, you may potentially be getting shorted some revenues in that particular realm. So again, that's something you're going to want to watch and make sure that you're updating. You can do that about once a year. Charges for services. Again, this is more building permits and other fees. We'll run through these real quick. The development fees, as of 2021, we are limited in how we can charge for development fees. And I shouldn't say it's additional clarification. Basically, we have to cover the actual cost of performing the plan review or performing the inspection, or it needs to be reasonable. And that's really what these underlying portions are getting at, is it needs to be reasonable. It can't just be a cash generating thing for the sake of raising cash. It needs to roughly offset what it's costing to provide those services. And so again, the state auditor is now asking us to restrict our revenues in excess of expenditures. And so that's a nuance that you're going to want to be very careful of, because those restricted revenues can only be used for those permitted expenses. And again, do your own study. Do not just call another city and say, hey, you're charging what? Okay, great. We'll charge that for our development fees. That will not pass the smell test. And so be very careful that you don't do that. And you're going to see that warning continually across the bottom. The transportation utility fee, this is in the legislative session right now. We think that this will pass. It should be passing here in the next couple of days. But essentially, if you do the study, if you follow all of the elements of the study, adopt an ordinance, and can demonstrate that you're going to only be using this money for transportation utility fee projects, then you have the ability to collect this revenue. This is a new stream for a lot of communities. I think 13 cities are currently charging this. The fact that it's being codified this year that lets us do this is a huge benefit, and the league has done a great job in making sure that that stays an option for us. But it's HB 367 if you want to follow that for the next few days. Utility bills, again, fees or taxes. Some people will say a fee is a tax. Don't want to argue too much on that one, but again, remember, when you're charging fees, similar things, it's going to have to be approved by resolution. As you set your utility fees, it should reasonably be related to the fee. Utility fees, you can be charging for capital, you can be charging for other elements. You just need to make sure that the fee that you're charging is tied to your capital, it's tied to whatever bonds you're planning on issuing. Those fees should be, part of that overall study of what you're trying to accomplish. Impact fees is a little bit different. Impact fees, I always recommend people have a solid capital facilities plan, which says what is all of the capital projects we need to build in a particular system. Then we ask ourselves, which of these projects are proportionately related to growth? You cannot use an impact fee to cure an existing deficiency. But if you are adding capacity and if you're creating capacity in your system, you can charge an impact fee for it. So this really gets back to the theory of who's paying for the new development. Should existing residents pay a rate for bonds, basically subsidizing new growth? Now, if you build a $1 million tank, and let's say half of it is to cure the existing deficiency, well, then that other $500,000, your residents will be paying on that bond, but they can get reimbursed with those impact fees paying that back. And so you need to make sure that you do your study, you identify those things, and then you make sure that the appropriate people are paying for their proportionate share of that capacity. So again, ultimately, you want to look for equity, and this was something that was in St. George's. Generational equity is the way that St. George put it in their policy. But again, it needs to be a balance of impact fees and user rate fees so that everybody's paying their appropriate proportion of that particular cost for development. Here's some sections of code. There's one exception that I wanted to point out, and that is for a political subdivision with a population of 5,000 or less. That charges an impact fee of less than $250,000 annually need not comply with the Impact Fee Act. So again, you will have to have a study. You will have to kind of follow the policies that are laid out in code, but you don't necessarily have to have the full-blown study that's usually pretty expensive to come up with. But small cities, you do have this carve out. Make sure you're using that for your appropriate things. Impact fees is going to have to be its own study and its own probably full hour to discuss all the nuances of it. But these are the relevant sections of code if you are interested in that. And with that, Liam, I'm going to turn it back to you and see if there's any questions or anything that we've missed that we want to make sure and cover before we wrap up this session.
Thanks, Mark. That was awesome. I was like trying to keep up with you through there. I felt like we were doing a marathon or something. So
when you rewatch the YouTube, just slow it down to 0.75 and it will come across perfect, I'm sure.
that's exactly what I'm going to do. I'm going to be watching this once or twice, I think, so I can get everything in. That was great. And hopefully we get you back for some of those other things that go into a little more detail.
You bet.
I don't see any questions in here right now. I do want everyone online to know that's with us right now, and then whoever watches it afterward. If you have questions about this, if you have questions for Mark specifically, we can get those questions to Mark. He's indicated that he's happy to answer those and help point people in the right direction. So if you need that, let me know. My contact information is on the website. My email or my cell phone. And thanks for joining us. Thanks, Mark, for this great webinar, and we will see you all next time.
Thank you. Have a great day.